Welcome to Lender's Digest. I'm Alex Cooper, and today we're diving into a topic that's crucial for anyone in the lending business: how revolving lines of credit play a pivotal role in underwriting and loan approvals. Let's start with the basics. A revolving line of credit is a flexible lending arrangement where a borrower can repeatedly draw funds up to a predetermined limit, repay, and borrow again. Think credit cards or home equity lines of credit. But how does this type of credit factor into the underwriting process? First, it's important to understand that revolving credit provides lenders with a wealth of information about a borrower's financial behavior. When underwriters examine a potential borrower's revolving credit history, they're looking at several key factors. One of the most critical is the credit utilization ratio. This is the percentage of available credit that a borrower is currently using. A low utilization ratio, typically under 30%, signals to lenders that the borrower is managing their credit responsibly. It suggests they're not overly reliant on credit and likely have the means to repay new loans. But it's not just about how much credit is being used. Underwriters also pay close attention to payment history. Consistent, on-time payments on revolving credit accounts demonstrate reliability and financial discipline. This track record can significantly boost a borrower's creditworthiness in the eyes of lenders. Another aspect that underwriters consider is the length of credit history. Long-standing revolving credit accounts that have been managed well over time can be a strong indicator of financial stability. This is why closing old credit card accounts can sometimes negatively impact a credit score. It shortens the average age of accounts. Now, let's talk about how revolving credit influences different types of loan approvals. For mortgage applications, a well-managed revolving credit history can be particularly impactful. It shows that the borrower can handle ongoing financial obligations, which is crucial for a long-term commitment like a home loan. In the world of business lending, revolving lines of credit take on added significance. They're often used as a benchmark for a company's cash flow management. A business that effectively uses its revolving credit without maxing it out can demonstrate to lenders that it has a solid grasp on its financial operations. However, it's not all positive. High balances on revolving credit accounts can raise red flags during the underwriting process. They might suggest that a borrower is overextended or relying too heavily on credit to make ends meet. This can lead to stricter lending terms or even loan denials. It's also worth noting that the impact of revolving credit can vary depending on the type of loan being sought. For example, auto lenders might weigh revolving credit history differently than a commercial real estate lender would. From an underwriter's perspective, revolving credit provides a window into a borrower's financial habits and capacity to manage debt. It's not just about the numbers. It's about the story those numbers tell about financial responsibility and risk. As we wrap up, it's clear that revolving lines of credit are more than just a convenient financial tool for borrowers. They're a critical component in the underwriting puzzle, offering lenders valuable insights that inform their decisions. For those in the lending industry, understanding the nuances of how revolving credit impacts underwriting can lead to more informed decisions and potentially better risk assessments. And for borrowers, recognizing the importance of managing revolving credit responsibly can be the key to unlocking more favorable loan terms. This has been Alex Cooper for Lender's Digest. Until next time, keep those credit lines revolving responsibly.